When it comes to building wealth, real estate has long been a preferred choice. It's an asset that can appreciate over time and provide cash flow through rental income. But beyond these, real estate also offers powerful tax benefits that can help increase your returns, whether you own a primary residence or an investment property. In this video, we'll explore some of the top tax advantages of owning real estate. Let's first look at the tax advantages tied to owning your primary home. One key benefit is the mortgage interest deduction. If you itemize your deductions, you can typically deduct interest on up to $750,000 of mortgage debt, or up to $1 million. For couples filing separately, each can deduct interest on $375K of debt. This deduction can reduce your taxable income significantly, especially if you have a large mortgage. Next, there's the property tax deduction. Generally, you can deduct property taxes, but there's a catch. The state and local tax deduction, or SALT, is capped at $10,000 for married couples and $5,000 for separate filers. If you live in a high-tax state, the SALT limit can feel restrictive. One strategy is to alternate between itemizing deductions one year and taking the standard deduction the next, which could maximize your benefits. Perhaps the biggest tax advantage of owning your home is the capital gains exclusion. When you sell your primary residence, you can exclude up to $250,000 of the gain if you're single, or up to $500,000 if married filing jointly. To qualify, you must have owned and lived in the home for at least 2 out of the last 5 years. There are exceptions if you sell for work, health reasons, or other unforeseen circumstances, which may still allow for a partial exclusion. While primary residences offer great tax perks, investment properties provide even more opportunities to save. Let's look at some of these benefits. One of the most significant is depreciation. With this deduction, you can claim a portion of your property's value each year to account for wear and tear, reducing your taxable income. For residential properties, you can depreciate over 27.5 years. For commercial, it's over 39 years. There are strategies to accelerate this, such as component depreciation, which could mean more deductions in the early years of ownership. However, be aware, when you sell, you may have to pay taxes on recaptured depreciation, but strategies like a 1031 exchange could help defer this. With investment properties, you can also deduct a range of expenses: mortgage interest, property taxes, insurance, repairs, and more. Keeping thorough records of these expenses can maximize your deductions and reduce your overall tax bill. Another tool for investors is the 1031 exchange. This allows you to defer capital gains taxes when you sell a property by reinvesting the proceeds in a similar property. You'll need to identify a replacement property within 45 days of selling the original and close within 180 days. A 1031 exchange lets you keep more of your money working for you in the market. The Section 199A deduction offers another tax break, allowing certain business owners, including real estate investors, to deduct up to 20% of their rental income, subject to income limits. This deduction can lower your effective tax rate on rental income, which is a win for high-income investors. For those who want to take their tax savings a step further, here are some advanced strategies. A cost segregation study can break down your property into components that depreciate faster than the typical 27.5 or 39 years. Cost segregation studies can be particularly valuable for properties with significant personal property or land improvements, such as multifamily buildings or commercial properties. While it requires an upfront investment, it can lead to substantial tax savings. Investing in opportunity zones, areas needing economic development, can offer significant tax benefits, including deferral and reduction of capital gains taxes. If you qualify as a real estate professional by spending at least 750 hours annually on your properties, you can offset your rental losses against your regular income, providing even more tax savings. Whether you're a homeowner or an investor, long-term planning here is key. For homeowners, think about how long you plan to stay and how your home equity fits into your financial goals. For investors, consider your exit strategy, whether it's selling, holding for cash flow, or passing the property on to your heirs. Debt is often part of real estate. Homeowners might decide whether to pay off their mortgage early, while investors may use refinancing to pull out equity. Managing debt strategically can improve your returns and impact your taxes. Meticulous record keeping is essential. Track your expenses, improvements, and cost basis to substantiate deductions, and if necessary, defend against audits. At Range, we understand the complexities of real estate ownership. Our all-in-one platform is designed to simplify tax planning for your properties with tools to help you keep track of investments, manage deductions, and visualize tax implications. Whether you're a homeowner or a seasoned investor, our team is here to guide you. If you want to learn more, head on over to range.com. Thanks for watching.